Hello everyone, this is Sumbula Fifa. Welcome to my channel Me to You Education. In this video, I am going to explain a very important topic of financial management, that is capital structure. So before starting this video, if you have not subscribed to my channel, please do like and subscribe. Now without wasting time, let's get started. First we'll understand the meaning of capital structure here. The combination of capital from different sources of long-term funds is called capital structure. So here by giving an example, I will explain you this meaning. Okay. Suppose you have one company and you want the growth of your company. The growth can be the expansion of business. The growth can be the diversification of business. Or growth can be the replacement of business. Or it can be the modification of business. Expansion of business refers what? Growth of the same existing business. That means you are running up one business and you want to expand your business. For its expansion, what you require? You require funds, right? Diversification of business refers what? Existing business with new business. That means you are running up one business and along with that business you want to open a new business. For example, you have Tata Steel Company. Okay. Now you want to open Tata Motors Company. Tata Motors is new business which you want to open. So to open a new business, what you require? You require funds, right? Next is replacement. Suppose in your factory or industry, some plants and machinery got outdated and you want to replace it with the new one. To replace it with the new one, what you require? You require funds, right? Next is modification of business. Modification of business refers you want to bring some new changes in your same existing business. To bring the new changes, what you require? You require funds, right? So all these activities are the long-term activities for which you require funds. And how the company raise these funds for its long-term activities? Through long-term sources. Okay, so under your long-term sources, your equity shares comes, your preference shares comes, your debentures comes, and other sources of long-term finance comes. Suppose a company require funds of rupees 20 lakhs. For what purpose? For the expansion of business. Okay. Whole 20 lakhs the company may raise by using only equity. Whole 20 lakhs the company may raise by using only preference, or it may raise whole funds by using only debenture. Or 50% of funds the company may raise by using equity shares, 25% by using preference shares, and 25% by debentures. Or company may raise 75% of funds by using equity and 25% by preference shares. Or it may raise funds of 50% by preference shares and 50% by debenture. Or it may raise 50% by equity and 50% by debenture. That means the company may raise whole funds by using only equity. Whole funds it may raise by using only preference. Whole funds the company may raise by using debenture. Or the company may raise whole funds by the combination of equity, preference, and debenture. Or it may raise whole funds by the combination of equity and preference. Or it may raise funds by the combination of preference and debenture. Or it may raise funds by the combination of equity and debenture. Okay, so the combination of these capital is called capital structure. So basically capital refers equity, preference, and debenture. Okay, and the combination of these capital is called capital structure. And equity, preference, debentures are the sources of long-term finance. Okay, actually the money market, the financial market is classified into two types. One is of money market and another one is of capital market. Okay, money market deals with the short term finance and capital market deals with the long term finance. Okay, money market is a market where money borrow and lend for a short period of time, that is for less than 1 year, that is from 0 to 364 days. Okay, where capital market is a market where money is borrow and lend for a long period of time, that is for more than 1 year. And these equity preference debentures are the sources of long term finance. Okay, now let's read the meaning. The combination of capital from different sources of long term funds is called capital structure. Capital is your equity, preference, debentures, and the combination, the mixture, the proportion of equity, preference, debentures, which are the different sources of long-term funds. So, equity, preference, debentures are the different sources of long-term funds, and the combination of these capital is called capital structure. So, in capital structure, company determines from which sources how much funds should be raised. Okay, from which sources, that means whether from equity, whether from preference or debenture, how much funds, whether 50%, 25%, 25%, how much funds should be raised. Okay, so the proportion in which capital raised from different securities is called capital structure. Hope the meaning is clear now. Now moving on to the next. That is, a financial manager choose that source of finance which minimize the cost of capital and maximize shareholders' value. See, who decides the capital structure of the company? It is decided by the financial managers. Okay, that means the capital structure of the company completely depends upon the financial managers of the company. Hence, the financial manager should have to design the capital structure in such a way which minimizes the cost of capital and maximizes shareholders' value, which is the main objective, minimizing cost of capital and maximizing shareholders' value is the main objective of the capital structure. Okay, and maximizing shareholders' value and minimizing cost of capital is also referred to as optimal capital structure or sound capital structure. Okay. Now let's see what are the factors which affect capital structure. So the company have to see if the company issues equity, how it affect to the capital structure. If the company issues debt, how it affect to the capital structure of the company. But to understand factors, it is important to know the basic differences between equity and debt. So let's have a look on the basic differences. Here the first point is return. The return on equity is called dividend and the return on debt is called as interest. So here I explain you this point. Suppose one XYZ company is there, okay, which is in need of funds of rupees 20 lakhs. Okay, so what the company do here? Company issues equity shares of rupees 15 lakhs and issues debentures of rupees 5 lakhs. Okay, and this is a person who purchases equity shares, so equity shareholder, and give money to the company. And this is a person who purchases debentures, so debenture holder, and give money to the company. Okay, company taking these funds, invest these funds into its business, and raise funds. After raising funds, what the company have to do here? Company has to give return, right? To whom? To its investors, right? So the return which the company pays on equity is called dividend, and the return which the company pays on debt is called interest. So this is what your first point. Okay, and the second point is the rate of return on equity is always variable and the rate of return on debenture is always fixed. That means the rate of return on equity is variable. Rate of return means the dividend. The dividends are always variable. That means not fixed. Dividends are always based on the profit or loss of the company. Okay, that means if the company earn profit, the company gives dividend on equity, that is to equity shareholder. If the company incur loss, company will not pay any dividend to its investors. Okay, so the return depends on the profit or loss of the company in case of equity. And in case of debt, the rate of return is always fixed. In case of debt, the rate of return is always fixed. That means the interest is not depend on the profit or loss of the company. That means whether the company earn profit or incur loss, it has to give interest to its investor, that is to debenture holder. So this is what your second point. Third point is here control. Equity shareholders have right to participate in the affairs of the company. Why they have the right to participate in the affairs of the company? Because equity shareholders are the real owners to the company. Okay, as they are the real owners to the company, they have the right to participate in the affairs of the company. They have the right to make decisions of the company, whereas debenture holder, they don't have right to participate in the affairs of the company. Why? Because debenture holders are just the creditors to the company. Okay, now the fourth point is redemption. Equity shares are irredeemable, whereas debentures are redeemable. Redeemable means can change or can buy back before maturity, before its maturity. For example, company issued debenture at the interest rate of suppose 10%. Okay, and after 3-4 years, company got to know that new debentures are issuing in the market at the interest rate of 7%. At that time, company have the flexibility to redeem the debentures. Okay, which is not in case of equity. Equity never redeem. Why? Because the dividends is based on company's profit in case of equity. Now let's understand the factors one by one, which is almost same to the points discussed in the differences between equity and debt. Equity and debt are the two main categories of finance available to entities to finance their operation. Okay, so the company has to see if it issue equity, how it affect to the capital structure of the company. If it issue debt, how it affect to the capital structure of the company. So here is the first point, cost to company. Cost to company in case of equity is higher than debt. See, if the company issues more and more equity, that means cost to company rises. How? As we have already discussed that the rate of return is always variable. The rate of return on equity is always variable. Variable means not fixed, isn't it? So the rate of return, that is dividend on equity is based on the profit or loss of the company. It means if the company earn profit, then only company pays dividend on equity, that is to the equity shareholder. If the company incur loss, then company will not pay any dividend to its investor. Okay, so the return is depends on the profit or loss of the company. What if the company earn more profit? Then company has to give more dividend, right, to the equity shareholder. Paying more dividend is what? Is a cost to company, right? Which is not in case of debentures, as interest rates are already fixed in case of debentures. Okay. Next point is risk to company. Risk to company in case of debt is higher or more than equity. How? See, in case of equity debenture, whether the company earn profit or incur loss, it has to pay interest to the debenture holder, right? Paying interest even when the company incurred loss is what? Risk to company, isn't it? Which is not in case of equity. If the company earn profit, then only company pays dividend to the equity shareholder. If the company incur loss, then company will not pay any dividend to the equity shareholder. Okay. Next point is control of company. Control of company. Equity reduces ownership of the company. See, as even this point we discussed, that equity shareholders are the real owners of the company. If they are the real owners of the company, that means they have a right to participate in the affairs of the company. If they participate in the affairs of the company, then obviously the control of the company get reduces, which is not in case of debentures, as debentures holders are just the creditors to the company. So the control of the company will not get affected by the issual of debentures. Okay, and the next point is that is flexibility. Flexibility, the company having flexibility in case of debenture to redeem it, but not in case of equity. As even this point we discussed previously, that debentures are redeemable and equity shares are irredeemable, isn't it? Debentures are redeemable means debentures can be changed or can buy back before maturity. For example, the company issued debenture at the interest rate of 10%. Okay, and after 3-4 years, the company got to know that new debentures are issuing in the market at the interest rate of 8%. At that time, the company having the flexibility to redeem the debentures. Okay, but this flexibility is not in case of equity, as equity never get redeemed. Why? Because dividends are based on company's profit. Okay, in case of equity. So all these factors the company should have to consider while deciding the capital structure. Okay, so if the company issues more and more equity, the cost to company rises. If the company issues more and more equity, the control of company reduces. At the same time, the company will not get any flexibility to redeem the equity, isn't it? Company will not get any flexibility in case of equity to redeem it. And if the company issues more and more debt, that means the risk to company increases. So keeping all these factors in mind, a financial manager should have to decide the capital structure in such a way which should maximizes shareholders value and minimizes cost to company.